Hey guys, today here on Swift Finance, we are going to discuss how you can survive the upcoming recession. First, try to relax. Recessions don't last forever. However, governments from all across the world are currently raising interest rates to help you combat growing inflation. This means that loans for expensive products like houses and cars will now have higher interest rates, resulting in higher payments. Higher interest rates makes customers less willing to spend money, which can lower demand for goods and push prices back down. This is how central banks typically combat inflation. Therefore, start saving your money and wait for the recession to end. If you're an investor, this is undoubtedly a very scary time for you. With the S&P 500 officially entering a bear market after falling by 20% from its most recent high, traditional equities have suffered greatly. This has caused the stock as a whole to lose $1 billion in value or more, forcing some portfolios to implode. Cryptocurrencies have nearly lost $1 trillion in value since March 2022. So if you're invested in them, you have undoubtedly felt this pain. Even Bitcoin, the biggest cryptocurrency, has seen a market valuation decline for more than $60 billion in the recent months. So the end doesn't appear to be in sight. Bear markets, though, aren't always awful for investors if you can preserve for a while. Remember, you don't lock in losses until you sell, so resist the desire to sell and reduce losses, unless you have a good reason to think your investment will drop to single digits. As a result of their widespread use, important coins such as Bitcoin, Ethereum, and Solana are unlikely to fail. People want to use these coins, and while they're still very risky, a well-established cryptocurrency has an overall lower risk than your friend's altcoin, which he airdropped you last week at McDonald's. The trick during a bear market is to avoid trying to time the market, regardless of whether you invest in more risky options like cryptocurrency or classic investments like equities. Stop looking for the next big thing and start investing like an adult by employing the time-tested method of dollar cost averaging. This implies that you always make a fixed investment at a fixed period regardless of the price. Paying off your credit card debt as soon as you can is the next best strategy for surviving a recession. Although it could be challenging, given the rising interest rates, this is extremely vital. This implies that the total amount of money you end up paying will continue to rise every month. A few percentage point increase in interest rates could result in you paying hundreds or even thousands more in the long run if you're paying low payments. So cut back on your spending and pay off your credit card debt quickly. The next thing you should do is make sure your money is saved. The last thing you want to do is lose your job and all of your funds during a recession. If you're fortunate enough to have loads of money, now that is the time to start looking for investments that can help you preserve your fortune over time without losing value. Gold and real estate have historically been strong inflation and recession hedges. However, stockpiling real estate now could come with its own risks due to worries about a burst in the housing bubble. By reducing supply and driving up price, purchasing real estate only as a means of storing your money only serves to exacerbate the situation for everyone else. Stocks suffer during recessions, but bonds are typically fairly reliable investments. Even though bond values have also been hit by the downturn, stocks are a form of partial ownership in a corporation, if you're wondering how they differ from one another. Therefore, if you purchase Apple stocks, you now have a stake in the business. However, when you buy a bond from a firm or a government, you're actually giving a loan to them. When you purchase a bond from a company or a government, that organization or entity is now obligated to repay you for the amount you purchased plus interest over a predetermined length of time before the bond is fully repaid. Bonds are great investments for anyone searching for a predictable income because you are promised a certain amount of interest on the bond each year. Since your return improves as the company's own worth increases, stocks can frequently produce noticeably superior outcomes. The return on your investments from a bond, though, is frequently significantly smaller, but is still very safe. The only true risk with a bond is if the organization you purchased from completely fails or tanks for some reason, such as a fall in a company or a nation. Bonds may continue to offer a modest but appreciating return through a recession, helping you weather the financial storm. Switching from stocks to bonds during recession might be a wise choice. That's all for our lecture. Hope you learned a thing or two during this video. Make sure to also like, subscribe, and share this video to help out the channel. Goodbye now.